Income ETFs can be a fantastic asset class to give investors regular income streams and a chance at diversification. These have exploded in popularity in recent years, and new ETFs seem to appear on a weekly basis like a new Pokemon. One brand spanking new ETF that launched in October of 2023 was FEPI, FEPI, the Rex FANG and Innovation Equity Premium Income ETF, ran by Rex Shares. Man, they must really love dinosaurs over there. Let's just hope they don't meet the same extinction fate as them. When the fund was launched, the ETF provider sent myself, and from what I hear, other finance YouTubers unsolicited gift cards. While I appreciate the extra pumpkin spice lattes that I'll be buying with this, don't you worry, my objectivity is not impaired. Don't worry, this was not a paid video. They never said I had to make a video. I'm making this video because I had several requests by viewers to do so. I'll be going over both the pros and cons of this ETF. I've also been playing email tag with the fund manager on getting a possible Q&A interview set up. So if you have any questions about FEPI, leave them in the comments below as you hit that like button, and it's very possible that I'll be asking your questions to the FEPI fund manager soon enough. So Scott, if you're watching this, get back to me. I'm your biggest fan, Stan. So what does FEPI do? By the way, this is just my hunch, but a lot of these income ETFs these days seem to have a very similar name to the very popular JEPI, which is ran by JP Morgan Chase. And I don't think that's any coincidence. There's definitely some intentional naming going on there. The goodwill that JEPI brought to this community in the past couple of years, or maybe, just maybe, Innovation Equity Premium Income ETF. It just has a really good ring to it. At the end of the day, the naming doesn't matter. How much money they put into our pockets, that's what matters. So what does FEPI do? So FEPI only has 15 stocks in it, as it seeks to get exposure to big tech and then give us shareholders the steady income by doing covered calls on those positions. The 15 stocks they own come from the Selective FANG Innovation Index. The FANG stocks, of course, consist of Facebook, Amazon, Netflix, and Google. Though these days, commonly other added-in stocks include Nvidia, Apple, Microsoft, and Tesla. These 8 companies, they're known for their significant influence on technology and the internet sector, and investors love these stocks because of their strong historical returns. In addition to these 8, the next 7 stocks in the index by aiming to get the next largest, most liquid tech-enabled stocks that are based out of the US. The index gets rebalanced every quarter, and there is a monthly re-weighting. In order to be part of this index, you also need to be part of the level 3 fact set industries, which includes sectors such as semiconductors, electronic equipment, components, data processors, internet software, and so many more. Those of you who watch this channel know I'm super bullish on semiconductors for the future, so I love to see that this is actually a criteria that they look for. It's a factor in choosing what stocks get added into this fund. From there, the index removes anything under a $10 billion market cap and then ranks based on the top 30 free float market cap. This essentially just means that they're looking for shares that are available for everyday trading. So it's going to exclude those held by insiders or government entities. And then they also look at 12-month average daily value traded. This represents how much consistent interest and liquidity a security has in a year, and this can indicate what stocks are popular, and more importantly, it could potentially lead to higher premiums when there's more volatility, there's better liquidity of bid to ask spreads, that becomes more favorable, market orders might get executed quicker, etc. So this is what FEPI's holdings look like currently. We have fantastic companies like Google, Netflix, Broadcom, Amazon, Salesforce, Nvidia. These are all great companies. And they all make up around 7% of this fund. So if you want to get diversified, this probably isn't the best fund because it's going to be very tech heavy. So we're not really getting exposure to other sectors out there. Tech doesn't always have a fantastic year. It's not always in the green. But hey, that's why there's other ETFs out there. That's why there's other stocks that exist. It's possible to get diversification. FEPI just happens to be very tech oriented. Now with these stocks, they're going to be doing slightly out of the money call options on them to harness the big tech volatility and get those juicy premiums. Now, by doing out of the money, there is a little bit of room for some stock gains. Just have to hope the stock doesn't shoot to the moon and then come down too quickly, which would be really bad news for this ETF. And unfortunately, that does happen from time to time with the stock market. You can actually see their call positions in their holdings. So if we go to the second page here, we see Apple with the January 19th, 2024 expiration date with a strike price of $205. So that gives the impression that it's about 1 month in advance. They're also strategic in doing different strike prices. For example, we see multiple strike prices for Adobe. One here is for $615. We have another one down here for $600, and then another one for $650. So different levels of how aggressive they want to be, different levels of risk versus reward. And I really like that because they're not putting all their eggs in one basket. The only stock on here that you've probably never heard of before is Palo Alto Networks. This is a cybersecurity company that's up nearly 400% in the past 5 years. Now, those are some super juicy gains. This is a company that doesn't pay dividends, so to be able to do covered calls and get consistent monthly income, I see that as a big win-win. Now, this strategy is great during these sideways markets or even during market declines. It's a chance to get some returns as those covered calls potentially won't hit and premiums just get collected and distributed to shareholders. Now let's talk about those monthly dividends. FEPI does pay monthly dividends. I intentionally waited to make this video after their second distribution just to get a larger sample size. Remember, this is still a relatively new fund, but it has impressed so far. Its first distribution was for $1.15. Their latest was for $1.17. So if we annualize that dividend using the first 2 months of history as sort of a gauge, we get a juicy, blistering dividend of 25%, which is an insane yield. But what I'm even more impressed with is that the stock price has actually went up nearly 7% in that same time span. Often what we're seeing with these high yielding income ETFs is that they erode their capital over time. So what's really the point of doing this dividend investing if the stock price is just going to keep going down and down? With FEPI, at least so far, we're not seeing that. Of course, this is a super small sample size. We need to see how this fund behaves over long periods of time during different economic conditions. The stock market as a whole has also just done amazing in recent months. SPY is up nearly 10% in 2 months so far. So it seems like FEPI, it's really firing on all cylinders, both with fat dividends and capital gains, the best of both worlds. FEPI, it kind of rhymes with confetti. No, it doesn't. It does, however, charge a 65 basis points expense ratio. That's $65 for every $10,000 invested. This is an actively managed fund. It's going to require more work than passively managed funds that just track an index. It is cheaper than YieldMax funds, which are typically around that 1% mark, but it's still more expensive than JEPI, which is just around 35 basis points. Taxes on distributions will be taxed as ordinary income unless in a tax-shielded account like an IRA. While there is new income ETFs coming out all the time, FEPI keeps it simple. They invest in high-quality companies, they're companies poised for growth, and we're able to make money by getting in on that options premium. There's no synthetically owning positions. There's no just one stock ETFs games being played here. Even though there isn't that many stocks in here, thanks to their weighting of just 15 companies, big swings and bad earnings reports, they're not going to hurt the fund as much. It's less likely to wipe out this fund than others. At the time of this recording, FEPI only has $23 million in assets under management. That's super small. JEPI, for comparison, has $30 billion that they're managing. But if they keep up these impressive returns, I see that number going up rather quickly. The only thing with better returns than FEPI has been my $165,000 stock portfolio, which has outpaced the S&P 500 this year. Lucky for you, it's available for your viewing pleasure, along with all my weekly trades in the link below. I make income ETF review videos like this all the time, so make sure you hit that subscribe button, leave a like for a small-time YouTuber. My videos are always found in podcast form under the Collect Cash podcast name. Let me know what comments and questions you have about FEPI, and I'll buy, stash, and collect cash you on the next one.